stock market crash of 1929.
Yay!
There are 5 major days leading up to the crash. The first of the 5 is Black Thursday. It's October 24th, 1929. There were so many trades going on in the market that stocks actually hit air pockets. There weren't any banking, brokerage, or industrial failures occurring, but there was still panic in the market. Many stock prices were dropping many points between trades, and the ticker could not stay up to date with all of these trades occurring. So the delay in the ticker caused even more panic, and the prices of the stocks dropped even more. The next major day is Black Monday. The banks tried to pump a lot of funds into the market to try and stabilize the market. This didn't work and prices fell even more, and the market actually fell 38 points that day, the largest drop on record. The final day is Black Tuesday, the day of doom. There was still a lot of trading going on in the market, even though the prices had been falling the past few days. But on Black Tuesday, the market hit its max. The transatlantic cable broke, the stock ticker stopped working, and the phone lines were jammed. This created a ticking time bomb. And then the Dow Jones proceeded to fall 30 more points that day, for a total of 68 points in the past few days. Then the market crashed. The environment of the 1920s was filled with confidence, irresponsibility, and prosperity. The establishment of the Federal Reserve increased free trade and decreased inflation. Discounting future values also became popular in the 20s. It's actually the most speculative method of valuing stocks, believe it or not. Furthermore, the government had a laissez-faire attitude at the time, which increased aggressive behavior in the market. Also, the use of leverage and consumer credit increased during this time. There were also a lot of technological advancements in the 20s, such as the radio, the Model T Ford, the aircraft industry, and motion picture with sound. The art of speculation. But what is speculation exactly? Speculation is an attempt to profit from changes in market price, and it's to reflect or theorize without a firm factual basis. According to George Soros, the application of speculators' ideas may actually change the conditions of the market. In other words, speculators may create their own self-fulfilling prophecies. What is crowd mentality theory? It's when an individual behaves rationally by themselves, but once in a crowd, they behave irrationally. There's a quote by Elias Canetti that states, "The crowd, or stock market, is inherently unstable, and at the moment of its dispersal, a crowd succumbs to panic. It is the very essence of a panic, that it bears no relation to the danger that threatens it and often breaks out on trivial occasions." What is cognitive dissonance theory? Basically, it's when people in the markets ignore bad news because they want immediate profits from speculation. So a group in the market will maintain a state of cognitive dissonance until the pain is greater than the reward or the fear of loss is greater than the greed for gain. All of the elements put together created a disaster waiting to happen. Using the discounting future values method led prices to increase, which led investors to be too optimistic about future prices. So this led to a vicious cycle of higher and higher prices and higher irrational expectations of investors in the stock market. And this vicious cycle created a speculative bubble. And with the market already at its peak, unfortunately, it had nowhere else to go but down. This is when the stock market crashed. So, wasn't it obvious? There have been several financial crises in the past that have all occurred because of speculative market bubbles. So here's a quote by Paul Wahlberg who sums it up pretty well. "History, which has a painful way of repeating itself, has taught mankind that a speculative overexpansion invariably ends in over-contradiction and distress. If orgies of speculation are permitted to spread too far, however, the ultimate collapse is certain not only to affect speculators themselves, but to also bring about a general depression involving the entire country."
So now that we know that speculation played a big role in the market during the 20s, would better reporting practices and more audits have helped? In order to answer this question, let's first take a look at the general purpose of auditing. So as you know, an audit is the examination of financial reports of an organization by an independent party. According to the AICPA, the main purpose of an audit is to provide an opinion that enhances the degree of confidence that intended users can place in the financial statements. Society, in the form of Wiki Answers, seems to agree with this in that they say that the audits add credibility to the financial statements.
So if investors are more confident in the financial information, how does the audit affect investor behavior?
Well, this can usually lead to wiser decisions, minimized losses, and increased gains. In a study done by Barton Waymeyer in 2004 regarding the 1929 stock market crash, he discovered that investors of firms with higher quality financial reporting had statistically smaller losses than those with lower quality financial reporting during this particular stock market crash. Waymeyer considered the purchase of an external audit to be a factor in determining a company's quality level of financial reporting, as well as conservatism and transparency. This suggests that accounting did play a role in minimizing losses during the crash. This brings us to two questions that we will now address regarding the role of accounting in the 1929 crash. So the main questions to be asked are, was the problem that there wasn't enough auditing or higher quality financial statements? In other words, if more existed at the time, could it have prevented the crash through minimizing losses? Or was it that audits were not fulfilling their purpose of reducing investor uncertainty, which could have dwarfed the bubble and resulting crash? To see if the lack of auditing and or high-quality financial statements was the culprit, let's see how common it was to have an audit done during the 1920s. The regulations were actually quite relaxed. There was a lot of variation in reporting, there's few disclosures, and audits were not even required.
So, since the regulations were relaxed, does this mean that not enough auditing information existed at the time?
No, not necessarily. It has been shown that there is a demand for auditing even in unregulated markets because managers respond to the desires of investors. So if investors want it, they create that demand, they'll get it, and managers will supply it. Also, according to Moody's manuals, 82% of the companies on the New York Stock Exchange in 1926 were already being audited by CPAs, so the lack of auditing did not seem to be the problem.
So, since there were plenty of audits going around, shouldn't this have reduced investor uncertainty and prevented the crash?
We say no, not necessarily. As we mentioned earlier, the market in the 1920s was full of speculation. It was a market prone to bubble. Due to cognitive dissonance and irrational behavior, most investors would not have used the accounting or auditing information regardless of the quality and availability. It simply would have bounced off the metaphorical wall created by speculation.
Boing!
The basis of our opinion is largely derived from an experiment done by Madsen, a professor at the University of Illinois. We like to call his experiment the bubble experiment. In the bubble experiment, he researched the effects of information complexity on information usage. Participants acted as investors in the market in which they could buy or sell certain types of stocks. The stocks would pay out a dividend each period. To adjust the complexity of the information available, he provided some participants with information that would help them predict how much of a dividend they would receive. Others had less clear information. The information represented the fundamental value of the stock. We would like to note that this fundamental value of stock disclosure is representative of high-quality financial information. So what he found was that in markets less prone to bubble, the use of accounting information regarding fundamental value of the stock leads to more efficient markets. But in markets more prone to bubble, the use of accounting information did not affect the efficiency of the market and did not affect investor trading behavior. So in other words, it is probable that accounting information is not the primary cause of a crash in a market prone to bubble. So what determines if a market is more or less prone to bubble? Hobson classified a market as being more or less prone to bubble by adjusting the endowed cash value relative to endowed shares. More cash allowed traders to drive up prices, fueling momentum and market clamor. In the context of the 1929 crash, the economy was doing well prior to the crash, which leads us to believe that investors had more money to spend on stocks, as was explained earlier. This extra money may indicate that the endowed cash value relative to endowed shares, mixed with speculation, created the environment for a market prone to bubble. Thus, since we believe that the market was more prone to bubble in the 1920s, it is probable that accounting information was not the primary cause. It seems as though speculation is more of the primary cause and accounting information is a secondary cause.
To summarize what we just learned, speculation was prevalent in the 1920s and created a market prone to bubble due to the booming economy, new inventions, rising stock prices, and optimism, which means there was more cash to spend and more stocks to buy. And this led to a cyclical speculative mindset that includes crowd mentality and cognitive dissonance.
So since the market was prone to bubble, accounting information would not have been considered in the market regardless of the quality and quantity, as proven in Hobson's bubble experiment. Thus, accounting information played a secondary role to the role of speculation in causing the 1929 stock market crash.
That's all we have for you today. Thanks for watching.